You're listening to the Economics and Country Risk podcast from S&P Global Market Intelligence. In each episode, our experts will provide you with the where, how, and when to make decisions that transform your business.
Good morning, good afternoon, and good evening. My name is Janine Cataldi, and I want to give a quick overview of our global construction outlook. So the first thing I want to do is just talk about some of the macroeconomic assumptions that went into our forecast. Now, these assumptions are from the December global macro. And again, that's when we did our forecast, was the end of December. And at the time, the global economics team was saying that there was going to be GDP growth global of 2.7 in 2023, 2.3% in 2024, and 2.6% in 2025. The slowdown in 2024 is largely due to the lagged effects of tighter financial conditions across the globe. This movement, this slowing, when you look across the markets, the US is going to have slower growth in 2024, as will Canada, Brazil, the United Kingdom, Russia, China, Japan, even India, which is growing very strong. It's still going to see some moderation into 2024. So we're really looking at this slowdown, again, lagged effects of tighter financial conditions. There is the expectation, though, that as markets begin to do some monetary easing, we're going to see, probably starting the second half of 2024, activity will be picking up. It will start to kind of bounce back a little bit. It'll get stronger. The Latin America region has already started going through some easing. They started probably the second half of 2023. That will continue through 2024. We also expect rate cuts to begin in the US and Canada and Mexico in 2024 at different times throughout the year. And then finally, the expectation is that Western Europe will probably be one of the latter regions to start cutting rates, but again, probably towards the end of 2024. So with these rate cuts, that's when you're going to start seeing the effects of these through lower inflation, stronger confidence in investment from both consumers and businesses. So we do expect a strengthening and a pick back up in 2025. Now, the Asia Pacific region, really over the next several years, is going to be the source of support for the global economy. Even with mainland China's growth slowing, it's still one of the stronger growth rates across the region. So how does this tie into some of the changes from our previous forecast for global construction spending? So our overall global spending outlook was not changed at all in 2023. We're still at 2.2%. And for 2024, we dropped marginally from 2.8% to 2.7%. And this is for global spending. But within the regions, there are some differences. Some regions are much lower growth and some are higher growth. So the first one I want to point out is the Asia Pacific region. And in this region, the 2023 growth rate has been downgraded to 3.6% from 4.4%. And this has to do with weaker growth in mainland China. Property downturn has been taking its toll, and official data through the first 3 quarters of 2023 have shown weaker than expected growth. That's the downgrade in 2023. And we expect this weakness to kind of carry over into 2024, which can be seen in the downgrade in growth from 4.2% to 3.9% for the Asia Pacific region. On the other side of this, you have Eastern Europe, where in 2023, we've upgraded the forecast from 2% to 3.9%. And this has to do with indicators showing much stronger than expected growth, particularly in Russia, which does account for nearly half of spending in Eastern Europe. And Russia has been investing in housing and a lot of public investment, and this is going to lift growth in 2023. The lower growth in 2024 is just the payback from having the stronger growth in 2023. Western Europe, you can see we've upgraded the forecast in 2023. It's not as weak, so it's at a negative 1.6% for 2023. And this has to do also with stronger than expected indicators coming in for some of the key markets, such as Germany. However, the outlook for 2024 has dropped to a negative 1.2% because there's the expectation that residential markets are still a long way from recovering. The weakness is expected to continue through 2024. And in addition to this, you have a lot of political uncertainty and some election concerns across the region that will have a dampening effect on investment. And then the final region that had some big changes was North America. And across this region in 2023 and 2024, we've upgraded significantly. All three markets had upgrades. Mexico is a big one. There's an expectation that there will be much stronger public investment spending from Mexico through the first half of 2024, if not a little bit longer, as public funds are expended on projects prior to the mid-year elections. The United States, we're also expecting stronger growth related to infrastructure and pickup in residential. And then in Canada, some of this adjustment in growth here is that we've adjusted the methodology used to generate the Canada construction forecast. So some of the levels and growth rates have changed beginning with this forecast, but the overall trends for Canada are the same. So that is also part of our changing growth rates here. So now I wanted to focus more on the segment spending. And again, residential was the weakest link in 2023. We do expect a bounce back in 2024. It's not a large bounce back. This is going to be a segment that is going to be slow to return to growth. And it's just going to be as interest rates come down, then the demand for housing will start to pick up. It's going to be a gradual process across the board. Non-residential structures, the slowing in 2024 is really just coming. 2023 was a big year for especially industrial. And as that levels off, you're going to see non-residential structures growth kind of start to slow down. And then finally, infrastructure spending is going to be the driver, as it has been for many cycles now. We do expect infrastructure to really push overall construction growth for the next several years. Now, looking at some of the individual segments, residential construction, weakness will remain in 2024, only in Western Europe. The rest of the markets are expected to see positive residential spending. And I believe that Western Europe, as rate cuts begin in the latter portion of 2024, this segment will start to bounce back in 2025. And non-residential structures, industrial spending, I do want to point out that while it looks like it's dropping off in 2024, this is essentially a leveling off. Levels are going to remain elevated. In fact, even on real terms, spending in the industrial segment is at levels that have not been seen really in many, many years. And after this huge rush of the past couple of years, it is expected that the segment will kind of stop, pause, take a breath, take a little bit of time to just regroup, and then continue to grow after that. So don't be alarmed by the leveling out in 2024. It's just kind of the segment taking a breather. The remaining segments are going to see relatively healthy growth. Commercial spending, that really comprises your retail, your warehouse, and those are some segments that have been growing well for a while now, and again are just going to kind of level off after years of robust growth. And finally, infrastructure. When you look at all the segments, everything is very strong. Water and sewer is strong. Transportation is strong. There's growth in energy. And we're always asked about the lower growth rate for energy. And I always just caveat that with the fact that when you're installing solar farms, wind farms, that's more manufactured product that's being installed on site. So the construction costs to put those up are minimal compared to some of the older traditional forms of energy construction. So just something to keep in mind. So with that, that's the very quick run through of the overview of global construction. And that actually brings us to the end of our time today.
Thank you for listening to the Economics and Country Risk podcast. Connect with us on LinkedIn and Twitter, and don't forget to subscribe to the podcast so you never miss an episode.